Okay, let's move on and let's welcome on board Dr. Aman Desai, the promoter and whole-time director at Aether Industries, joining in on the show right now. Dr. Desai, good to have you on the show. I'm just wondering, Europe has about 15% global market share in the chemicals market. Given the fact that industries are now either shutting down or reducing production because of high energy prices and the crunch there, are you seeing more orders coming your way because of this?
Hi, thank you for having me. First of all, a pleasure to be here. I think yes, we are seeing more opportunities and more inquiries come into the chemical industry in general. I think specialty chemical industry specifically from Europe because of the energy crisis, the war crisis, and the resulting scenarios that happen from these two crises in Europe into India. And it's an interesting space right now. It's just about starting, but we are seeing credible, significant, and permanent inquiries actually coming in and increase in the number of inquiries in the frequencies of interactions with the major chemical companies in Europe.
Dr. Desai, is the Indian chemical industry, according to you, equipped for the surge in demand? How quickly can we tap into this growing opportunity, and what can India's share in the global pie grow to from the current 6%?
Well, as you can think about, the number 6% is quite low already to begin with, and so there's a lot of headroom for growth over there. In terms of the capex being installed by various chemical companies in India, I think it's tremendous capex going on right now. Even in our company, we are planning significant capex in terms of 2 new greenfield manufacturing sites and a third one on the horizon in the next 3 to 4 years. And so we are aggressively planning capex and new facilities. And I think the other chem companies and the chemical industry in India in general is doing the same. And so I think we are gearing up for this golden age. I believe what I've been saying for the last couple of years now is that it's a golden age right now for the Indian chemical industry. And I believe the Indian chemical industry is gearing up for this golden age. And I think we need to do that fast. We need to put steel on the ground. We need to build plants. We need to build facilities, and we need to commission these facilities. And remember that these are complex chemical processes, right? And so these are not easy to install and just run like an assembly plant. So we need to be doing this. I think there's significant headroom for growth, and we need to quickly capitalize on the opportunities that is presented to the Indian chemical industry today, where if we can deliver on the cost and the quality and the time and the trust and the intellectual property protection, India is the preferred destination today worldwide for partnership in research and scale up and manufacturing.
That is how the supply chain issues are also impacting global markets. But the other way to look at it is the overall slowdown in demand too. Around 30% of your revenues come in from Europe, or rather they did in FY22. Could you tell us if there is a slowdown in the overall demand as well that you are seeing because of what's happening in that geography?
I don't think the demand slowdown is because of the current reasons that we are discussing right now, the war crisis and the energy crisis. What we are seeing as a slowdown in the demand is in the pharmaceutical sector. And that has to do with the COVID impact ruling the world and being guided by the principles of medicine in the pharmaceutical industry. And so I think people were just not sure of what's going to happen next and what's happening now in the pandemic time. And so people stockpiled inventory across the value chain, intermediates, advanced intermediates, actives, formulations. And so I think there's tremendous stockpiling going on, I believe, and that is now being used up. And so I think we're seeing a slowdown in the pharmaceutical market, which we as a company are also seeing. But in the other sectors, the agrochemicals, the material sciences, the oil and gas, and those coming from Europe, in these sectors, we are not seeing any slowdown right now. Rather, more inquiries are coming in for additional partnerships and additional outsourcing. And so as of now, we are not seeing slowdown, but I think if this crisis goes on for a longer time in Europe, all the sectors are going to get affected. And for sure, I think there will be a slowdown. But as of now, there's nothing.
So given the fact that, you're saying that if we do see a slowdown, there would be some sort of an opportunity of Europe plus one, net, what would that mean for your business?
I think that would mean net increased opportunities for capitalization on these opportunities in terms of extra manufacturing, more R&D projects, more CRAMs projects, and more CRAMs opportunities, and more contract manufacturing opportunities, which will get us into a position to be in the fortunate position to be able to pick and choose in the opportunities that we work with. In addition to our own pipeline of molecules that we have, which we introduced for the first time in India, we also do about 35-40% of contract manufacturing opportunities from customers worldwide in various industry sectors. And so in that opportunity bucket, which we call the CRAMs, contract research and contract manufacturing bucket, we are seeing an increased influx of opportunities, and net this will mean that we'll be able to pick and choose and go after the more attractive projects, the more lucrative projects in terms of revenues, and more importantly, finalize and strengthen the strategic relationships that we have with multiple innovator customers across the industry spectrum and focus on their projects more as they come in with more inquiries, which is what we're doing.
And what is the current utilization level? What are you looking to improve that at?
What is the current realization level?
Utilization
of
level.
Projects, you mean?
I'm asking about your utilization level, whether or not you can, improve it on the current quarter revenue, until site number 3 gets ready.
Yeah, so the current utilization number, I believe, is around 80-85% thereabouts, and we are looking at improving that. And the site 3 is on track, on schedule, and we are going to launch the first product in site 3 in December. And the first 3 products we are launching in the site 3 in December, January, February timeframe is already being validated. The process is being validated, and commercial quantities are being manufactured, and the validation quantities are being given to customers from the existing site. The unutilized assets in the existing site are being utilized for the validation of the site 3 products, so that when we actually start site 3, it's not a new product in a new site, it's just an existing product in a new site, and we can hit the ground running, and the validations with the customers already done as well. And so the underutilization, non-utilization is being used in that manner. And some of these opportunities that are coming in will be targeting for utilization and occupancy in these underutilized assets in the next 3 to 4 months. But as the inquiries come in, there's a gestation period of the inquiries being discussed, the costings being done, the estimations being done, the lab work and the pilot plant being worked done. And so you're looking at 3 to 4 months till any of these inquiries make it into the production, which is a timeline that we are currently working on.
And you're also looking to increase the CRAMs contribution from 33% to 33% from the current 12 to 14% levels. How will that help scale up your overall margins, and what kind of a margin upside can we expect?
Yeah, so that's an interesting question. Currently, we classify the second business model as the CRAMS business model, which is the research and the pilot plant business model, which is about 12% of our revenues in the last quarter. And when the molecule over here transfers into the exclusive manufacturing bucket under exclusive contract manufacturing with the customers, it goes into the third bucket, which is 33% right now. And so as these new opportunities come in, and as the current projects in the CRAMS research area translate into the contract manufacturing space, which are now being occupied by innovator pipeline under patent molecules of various innovators across the globe, across the industry spectrum, we firmly expect that the margins of the exclusive manufacturing bucket will go up. Currently, it is 28 to 30%, 28-29% margins on that exclusive manufacturing bucket, and we expect that margin to be going up over the next 1 to 3 years as more products from the CRAMS bucket get transferred into the exclusive manufacturing bucket, which will be very interesting.
All right, we'll let you go on that note. Appreciate you taking the time out, joining in and giving us an overall view on the business and how things are shaping up when it comes to the sector as well.